Price moves all week, but it never gives full freedom. The week forms inside stacked memory. This is the full weekly structure review. Not a recap, not a prediction. We enter the week like live trading. You see the level. You feel the pressure. You decide. Long, short, stop, target, trail, or no trade. That is the point. A trader does not need every move. A trader needs the right move. This week gives all of them. A breakout. A failed extension. A safer stop. A long from lower memory. A short bias with no clean trade. A trail after price earns distance. And a final session that refuses execution. The chart keeps asking the same question. Can price stay there? If it can stay, the trade survives. If it cannot stay, it returns. If distance becomes shorter, the move weakens. If reaction comes faster, continuation fails earlier. If the session forms inside old memory, the trade needs more proof. That is how we read the week. First, we go through the 1-hour chart. Monday to Friday. One session at a time. Asia session. US session. Entry line. Stop line. Target line. Risk reward. We do not chase candles. We wait for the boundary. We do not force direction. We wait for behavior. We do not protect emotion. We protect structure. When price reaches a session boundary, it must decide. It holds. Or it fails. That decision creates the trade. After the 1-hour chart, we step back. Daily chart. Weekly chart. Monthly chart. Then the week becomes clearer. The higher time frame shows why the 1-hour chart moved that way. Why some longs worked. Why some shorts failed. Why late entries had no space. Why some sessions gave no trade. Why next week needs caution. The 1-hour chart gives execution. The daily chart gives space. The weekly chart gives pressure. The monthly chart gives the larger memory. You need all of them. Because next week does not start from zero. It starts from what this week left behind. So watch carefully. The first 5 trading sections show the action. The final higher time frame sections show the reason. By the end, the plan is not prediction. The plan is preparation. Price reaches. It reacts. It holds or fails. Then you execute. Price breaks up, but it cannot stay there. The session forms inside stacked memory. April 26th Asia session forms inside the combined structure of April 24th US session box and April 22nd US session box. It does not form alone. It forms inside old pressure. The box sits across prior US memory. That matters. Price is not moving from open space. Price is moving inside a crowded range. The first push goes up. It reaches April 24th US session upper boundary. It breaks above. The move looks strong, but strength must travel. It must create distance. It must stay above the line. Price pushes again. It reaches April 22nd US session upper boundary. It breaks above that line too. Now the move looks even stronger. But the reaction starts to matter. The candles still move up, but the distance begins to stretch. The move is no longer early. It is now extended. Price reaches April 26th Asia session box. 150% extension. It touches. It stalls. It cannot move cleanly away. That is where pressure changes. If price is still strong, it should hold above the extension. It should build distance. It should make pullbacks shallow. But here, the reaction comes faster. The move pauses. The distance stops growing. The market reaches higher, but it cannot stay higher. That failure gives the short entry line. April 26th Asia session box. 150% extension. Stop loss line. April 26th Asia session box. 200% extension. Take profit line. April 26th Asia session box, lower boundary. Risk-reward ratio 2.92. The short does not come from guessing the top. It comes from failed extension. Price reaches the 150% extension. It tries to hold. It cannot stay. It reacts back. That reaction is the signal. You are not shorting because price is high. You are shorting because price cannot keep control after reaching extension. The stop sits at April 26th Asia session box. 200% extension. That line protects the setup. If price reaches the 200% extension, the 150% failure has failed. The market has expanded again. The short no longer has control. You leave there. Not because you feel fear, because structure has changed. The target sits at April 26th Asia session box lower boundary. When extension fails, price often returns to the box. Not always to the deepest level. Not always to a crash. First, it returns to the structure that created the extension. That is the lower boundary. So the target is not emotional. It is the return line. Price starts to drop. It breaks back below April 26th Asia session box upper boundary. Now the extension is gone. The market returns into the box. Then price drops again. It breaks below April 24th US session upper boundary. Then it breaks below April 24th US session lower boundary. The failure expands. The short is working. But you still watch the same thing. Does price continue? Does reaction slow? Does distance shrink? Price keeps moving down. It reaches April 23rd US session lower boundary. It tests. It pauses. That is where the drop loses clean speed. Now the market tries to recover. It moves back upward. It returns inside April 23rd US session box. That matters. The short from extension has already paid. The market has returned to old memory. You do not demand more unless price earns it. Now look at the second side. If you had a position from the previous day, the long also had a structure. Long entry line. April 23rd US session box lower boundary. Stop loss line. February 4th US session box lower boundary. Take profit line. April 24th US session box upper boundary. That long comes from a different behavior. Price reaches April 23rd US session lower boundary. It holds. It does not get pushed out. It moves away. That creates the long. The stop could look closer. Some traders may use April 23rd US session box. 150% lower extension. That improves the ratio. It looks cleaner on paper. But the April 23rd US session 13 o'clock candle has a long wick. That wick matters. Price can move deep without breaking the structure. A tight stop can get touched. Then price can move in the planned direction. You are right, but you are gone. So the safer stop sits at February 4th US session box lower boundary. It gives the trade room. It avoids the wick zone. It accepts a wider stop, but it protects survival. The result later shows the April 23rd US 150% lower extension was not touched, so the tighter stop could have worked. But we do not build method from the final result. We build method from survival probability. The market does not reward the prettiest risk-reward ratio. It rewards the position that survives normal movement. That is why the deeper stop matters. Now trailing begins only after price earns distance. First, trailing target. April 22nd U.S. session box upper boundary. Price already moved away. The trade has space. Now you can raise expectation. But you cannot raise the target alone. When the target moves higher, the stop must also move. If the stop stays too low, you are only adding hope. You are not managing risk. Second trailing target. April 26th Asia session box. 150% extension. Or April 22nd U.S. session box. 150% extension. Risk-reward ratio. 4.13. That trail only works after price proves movement. Price must move away from entry. Price must hold above old boundaries. Price must not return too fast. Then the trail can follow. But the stop must not become too tight. If you raise the stop too close, normal reaction touches it. Then the trade ends early. Profit becomes smaller than the original plan. That happens often. Trailing should improve the trade. It should not damage the trade. If the new stop, when placed with enough space, still sits below the entry line, then do not trail. That trail does not protect you. It only changes the plan. A trail must protect profit, or protect the trade after real distance. If it does neither, it is not management. It is interference. So the rule stays simple. Price reaches extension. It cannot stay. Short forms. Price reaches old lower memory. It holds. Long can survive. Price moves away. Trail only after proof. If trailing makes the stop worse, you do not trail. The session gives opportunity. But it also punishes impatience. Price drops again. But the stop must survive. The session forms inside older memory. April 27th U.S. session forms. Inside April 23rd U.S. session box. It is more compressed. It overlaps completely. The market is not starting from a clean range. It is starting inside a prior U.S. box. That matters. When a new U.S. session forms inside April 23rd U.S. session box, the first move can look strong, but the structure is already crowded. Price does not need much distance to hit old memory. So every stop matters. Every entry needs proof. Every target needs a real boundary. April 27th U.S. session begins inside that compressed overlap. Then price drops. It breaks below April 23rd U.S. session lower boundary. It does not hold inside. It moves lower. Then price breaks below April 17th U.S. session upper boundary. That adds pressure. The drop is no longer only inside April 23rd memory. It is now moving into April 17th memory. Then price reaches April 17th U.S. session midpoint. It tests. It slows. The first clean downside objective appears there. Now the short setup becomes clear. Short entry line. April 27th U.S. session box midpoint. Stop loss line. April 26th Asia session box midpoint. Take profit line. April 17th U.S. session box midpoint. Risk-reward ratio. 1.76. The entry sits at April 27th U.S. session midpoint. Why there? Because price forms inside April 23rd U.S. memory. Then it drops. When price loses the midpoint, the session starts leaning down. If price cannot reclaim the midpoint, the short has control. You do not short after the entire drop. You short where the session First loses balance. The midpoint becomes the decision line. Price holds below it. The short survives. Price reclaims it. The short weakens. The target sits at April 17th U.S. session midpoint. Price already broke below April 23rd U.S. lower boundary. Then it broke below April 17th U.S. upper boundary. The next test is the middle of April 17th U.S. session box. So the target sits there, not below it, not far away, at the next memory. That keeps the trade practical. Now the stop decision matters more. There are two stop options. First option, April 26th, Asia session box midpoint. Second option, April 24th U.S. session box midpoint. The second option gives a better risk-reward ratio. It looks attractive. The stop is closer. The ratio improves. But better ratio does not always mean better execution. The chart already gave a warning. On April 27th, the New York 10 o'clock candle already touched April 24th U.S. session box midpoint. That matters. If a level was already touched during the same active structure, placing a stop there can be weak. Price can retest it again. It can touch it without changing the larger setup. Then you are out. The direction may still work, but your stop did not survive. So the safer stop uses April 26th Asia session box midpoint. Why? April 26th Asia session box has wider volatility than April 24th U.S. session box. It gives more room. It is also newer. Newer memory matters. The market just reacted around April 26th Asia structure. That box still controls current pressure. April 24th U.S. session is older and already touched. April 26th Asia session is newer and wider. So the safer stop sits at April 26th Asia midpoint. The risk-reward ratio is lower, but the trade is stronger. That is the decision. You can choose the tighter stop if you want better numbers, but you must accept higher stop-out risk. You can choose the wider stop if you want better survival. Here, the wider stop is preferred, because the goal is not the best-looking ratio. The goal is executable structure. Now price drops from the midpoint. It moves down. It reaches April 23rd U.S. session lower boundary. It breaks below. It continues. It reaches April 17th U.S. session upper boundary. It breaks below again. The move has pressure, but you still do not relax. A working short still needs management. Price can snap back. The red Bollinger movement is wide. Volatility expands. Reactions can be violent, so you watch the stop line. Can price reclaim April 27th U.S. session midpoint? Can price move back toward April 26th Asia session midpoint? If price cannot reclaim, the short remains alive. If price reaches the stop, the trade ends. No debate. Now price reaches April 17th U.S. session midpoint. It tests. It pauses. That is the target. Risk-reward ratio 1.76. The trade has completed its job. You do not demand more from the same plan. If price breaks below April 17th U.S. midpoint and holds, a new trade may form. But that is not the original trade. The original trade was April 27th midpoint failure to April 17th midpoint return. That structure is complete. Now look at why this trade matters. April 27th U.S. session forms inside April 23rd U.S. session box. It is compressed. That creates sharp movement. But it also creates stop risk. Compressed sessions can break fast. They can also snap back fast. So the stop cannot sit at a line already touched by the active candle sequence. That is why April 24th U.S. midpoint is weaker. It gives a better ratio, but it does not give better survival. April 26th Asia midpoint gives more room. It respects the newer box. It respects the wider volatility. It keeps the short alive, unless the market truly reclaims the upper structure. That is how this method works. You do not place the stop where the ratio looks good. You place the stop where the trade is actually wrong. If price only retests April 24th U.S. midpoint, the short may still be valid. If price reaches April 26th Asia midpoint, the downside failure is much more serious. That is why the stop goes there. Now connect Part 1 and Part 2. April 26th Asia session showed extension failure. Price reached 150% extension. It could not stay. The short formed there. Then price returned to the box. April 27th U.S. session showed compressed overlap failure. Price formed inside April 23rd U.S. box. It lost the midpoint. The short formed there. Different setups. Same rule. Price reaches. It cannot stay. It returns. The entry changes. The stop changes. The target changes. But the logic stays the same. April 26th short uses extension. April 27th short uses midpoint loss. April 26th stop uses 200% extension. April 27th stop uses April 26th Asia midpoint. April 26th target uses April 26th Asia lower boundary. April 27th target uses April 17th U.S. midpoint. No prediction. Only tested memory. Now the final pressure. If price returns above April 27th U.S. midpoint, the short loses force. If price returns toward April 26th Asia midpoint, the trade is in danger. If price holds below April 17th U.S. midpoint, new downside can open. If price bounces from it, the move has completed. So next action is not emotional. It is conditional. Price must prove. It must hold. Or it must fail. Until then, you wait. The session gives the line. The candle gives the reaction. The reaction gives the trade. Price moves up first, but it cannot stay above. The session forms inside old pressure. April 27th Asia session forms between April 17th U.S. session midpoint and April 17th U.S. session upper boundary. It forms at almost half compression. The box is narrow. The distance is short. Price is not moving from open space. It forms inside April 17th U.S. memory. That matters. When a session forms between midpoint and upper boundary, price already sits near a decision area. It can push above. It can fail fast. It can return inside. So you do not chase the first lift. You wait for the boundary. Price moves up. It reaches April 17th U.S. session upper boundary. It breaks above. The move looks strong, but strength must stay. It must move away. It must create distance. Here, price pushes higher. It reaches April 27th U.S. session lower boundary. It tests the level. Then it slows. The move does not keep distance. The reaction comes faster. Buying loses control. That is where the short starts to form. Not at the first red candle. Not after panic. at the failed hold above April 17th U.S. upper boundary. Price came up. It reached the old upper boundary. It moved through. Then it failed to stay. That failure matters more than the break. April 27th Asia session gives the short setup. Short entry line. April 17th U.S. session upper boundary. Stop loss line. April 27th U.S. session midpoint. Take profit line. April 27th Asia session lower boundary. The entry line sits at April 17th U.S. upper boundary. Why there? Because price tested above it. It could not keep control. It returned back toward that boundary. If price cannot stay above April 17th U.S. upper boundary, the upward attempt has failed. That is where the short forms. The stop sits at April 27th U.S. session midpoint. This stop is not the prettiest number. It is the safer line. There is another option. April 27th U.S. session lower boundary. That stop gives a better risk-reward ratio. It looks cleaner. It looks more efficient. But live trading does not reward clean numbers. It rewards stops that survive. Before this short forms, the earlier April 27th Asia candles already tried to test April 27th U.S. session lower boundary. That area has already been pressured. A stop placed there can get touched again. Price can touch it without true failure. Price can wick into it. Then price can still fall. You are right about direction, but you are gone. So the safer stop moves higher. April 27th U.S. session midpoint. If price reaches that midpoint, the short has lost more control. The return above the lower boundary is not just noise anymore. It is stronger recovery into the U.S. box. That is why the stop goes there. The target sits at April 27th Asia session lower boundary. Price formed inside the Asia box. It broke up and failed. When the failed break returns, the first target is the lower side of its own session memory. You do not need a collapse. You need the failed break to return home. That is enough. Price drops. It moves back inside April 27th Asia session box. It continues lower. It tries to reach April 17th U.S. session lower boundary. But watch the movement. It is not clean forever. The first drop is sharp. Then candles slow. Pullbacks deepen. Distance becomes shorter. That is where you manage. The short is working, but the market is still inside old memory. You do not hold blindly. You watch the next boundary. First trailing target. April 21st U.S. session upper boundary. Price has moved away from entry. The trade has earned distance. Now the target can move lower. But target cannot move alone. The stop must also move. If the stop stays too far behind, you are not trailing. You are just hoping. If the stop moves too tight, the market touches it. Then the original plan may have paid more. That mistake happens often. A trail must protect profit, but it must still give space. Price drops again. It reaches toward older memory. The second trailing target becomes April 21st Asia session lower boundary. Risk-reward ratio, 3.25. That second trail can work only after proof. Price must keep moving away. Price must fail to reclaim the prior boundary. Price must make lower reactions. Then the trail earns the right to extend. But the stop must follow with enough room. If you raise the stop too close, normal reaction takes you out. Then the trail becomes worse than no trail. If you raise the stop with enough room, but it still remains below the entry line, the trail does not protect profit. Then you should not trail. That matters. Trailing should improve the trade. It should not make the trade weaker. If the new stop does not cross beyond entry, or at least protect the earned structure, you stay with the original plan. or you take the profit. You do not pretend management exists when the line still gives risk back to the market. Now look at the whole short again. April 27th Asia session forms compressed between April 17th U.S. midpoint and April 17th U.S. upper boundary. Price breaks above April 17th U.S. upper boundary. It reaches April 27th U.S. lower boundary. It cannot stay. It returns. Short entry comes at April 17th U.S. upper boundary. Stop goes to April 27th U.S. midpoint. Target goes to April 27th Asia lower boundary. Then trailing can extend toward April 21st U.S. upper boundary. Then toward April 21st Asia lower boundary. Risk-reward ratio reaches 3.25 only after the trade earns movement. Nothing starts from prediction. Everything starts from failed holding. The key mistake is stop placement. A stop at April 27th U.S. lower boundary looks better, but that line was already under pressure. The safer stop sits at April 27th U.S. midpoint, because if price reaches there, the short is no longer clean. The move failed above. It dropped. Then it would be returning too deep. That is enough to leave. The market does not care that the tighter stop gives a better ratio. It only cares whether your stop survives the real movement. So the rule stays clear. Do not place a stop where price already tried to test. Do not trail unless the trade has earned distance. Do not move the target without moving the stop. Do not tighten the stop until structure allows it. Price reaches. It fails. It returns. Then you execute. Price turns up again. But the long needs room. The session forms inside lower memory. April 28th U.S. session forms between April 17th U.S. session midpoint and April 17th U.S. session lower boundary. It forms at almost half compression. It overlaps lower structure. April 27th Asia session box and April 28th U.S. session box together almost match the inside of April 17th U.S. session box. That overlap matters. The market is not free. The market is building inside April 17th memory. When two newer boxes combine and almost fill an older U.S. box, price can move sharply from one side to the other, but it can also return fast. So the trade needs structure. It cannot be chase. April 28th U.S. session first forms lower. Price holds near the lower side. It does not collapse. It starts to lift. Now the long setup appears. Long entry line. April 28th U.S. session lower boundary. Stop loss line. April 21st U.S. session box. 150% lower extension. Take profit line. April 27th Asia session midpoint. First trailing target. April 17th U.S. session upper boundary. Second trailing target. April 27th U.S. session lower boundary. Risk-reward ratio 3.18. The long begins at April 28th U.S. session lower boundary. Why there? Because price forms near the lower side of the compressed structure. It does not break down cleanly. It starts to move away. If price holds the lower boundary, the long can start. If price loses that boundary, the long has no reason. The entry line is not the middle. It is the lower boundary. In compressed structure, midpoint entries can be dangerous. The box is too narrow. Price can cross midpoint repeatedly without choosing direction. That is why the lower boundary matters. Price must show it can hold the edge. Then the long has space. The first target is April 27th Asia session midpoint. That target is not random. April 27th Asia session created the prior short pressure. Its midpoint becomes the first memory above. If price rises from April 28th U.S. lower boundary, the first serious test is the April 27th Asia midpoint. You take that seriously. If price reaches it and stalls, the long has paid its first job. If it holds above it, the trail can begin. Now the stop decision matters. There are two stop options. First option, April 21st U.S. session box, lower boundary. Second option, April 21st U.S. session box, 150% lower extension. The first option gives a better risk-reward ratio. It is closer. It looks attractive. But the chart already gave the warning. During April 28th U.S. session candles, price already touched April 21st U.S. session lower boundary. That matters. A level already touched can be touched again. A retest does not always mean the long is wrong. It can be noise. It can be wick pressure. It can be a normal check of lower memory. If your stop sits there, the trade may end before the structure fails. So the safer stop sits deeper. April 21st U.S. session box, 150% lower extension. That gives the trade room. It reduces the chance of getting stopped by the same tested level. The ratio becomes less pretty, but the trade has better survival. Again, the method does not chase the best-looking number. It protects the position where the idea actually fails. If price reaches April 21st U.S. 150% lower extension, the lower memory is no longer holding. The long is wrong. That is the stop. Now price moves upward. It reaches April 27th Asia midpoint. It reacts. It does not need to be perfect. It needs to stay. If price holds and moves away, the first trailing stage can begin. First trailing target. April 17th U.S. session upper boundary. Price has moved from lower memory toward the older April 17th range. The target can expand. But the stop must move too. You cannot raise the target and leave the stop behind. That is not management. That is greed. The stop must follow the structure, but it cannot be too tight. If it sits too close to current price, the market touches it. Then you earn less than the original plan. A good trail gives price room while protecting the earned move. Price continues. It reaches toward April 17th U.S. upper boundary. That area matters. April 28th U.S. session formed inside April 17th lower memory. If price reaches April 17th upper boundary, the move has traveled through the old box. That is a major return. Now the second trailing target can appear. Second trailing target. April 27th U.S. session lower boundary. Risk-reward ratio 3.18. The target moves there only after proof. Price must move away from entry. Price must hold above April 27th Asia midpoint. Price must not collapse back below the lower memory. Then the trade earns extension. If price does not earn that distance, you do not use the second trail. No proof. No trail. No movement away. No larger target. Now, the important warning. April 21st U.S. session box and April 27th U.S. session box have narrow ranges. Their midpoints are not good lines for entry, stop, or target. Why? Because narrow boxes make midpoint too thin. Price can cross the midpoint without changing structure. A midpoint inside a narrow box can act like noise. If you use it as a stop, you may get removed too early. If you use it as entry, you may enter inside chop. If you use it as target, you may exit before the structure completes. So for April 21st U.S. and April 27th U.S. session boxes, avoid using midpoint as the main execution line. Use upper boundary. Use lower boundary. Use extension. Use a line that shows real failure. The trade depends on survival. Now connect the long. April 28th U.S. session forms compressed inside April 17th U.S. lower structure. April 27th Asia and April 28th U.S. together fill the old April 17th box. Price holds the lower boundary. Long entry starts there. Stop goes below. April 21st U.S. 150% lower extension. Target begins at April 27th Asia midpoint. Trail can extend to April 17th U.S. upper boundary. Then to April 27th U.S. lower boundary. Risk-reward ratio reaches 3.18 after the trade earns movement. The core problem is not direction. The core problem is stop survival. A tighter stop at April 21st U.S. lower boundary looks better. But that level was already touched. The safer stop goes deeper. A midpoint inside narrow boxes looks usable, but it does not carry enough weight. Use stronger boundaries. Use extensions. Use newer and wider memory. Now, look at the full structure. Part 1 gave the short. Price failed above April 17th U.S. upper boundary. It returned into April 27th Asia memory. Part 2 gives the long. Price holds April 28th U.S. lower boundary. It moves back toward older upper memory. Same market. Opposite trades. Not because opinion changed, because behavior changed. Short forms when price cannot stay above. Long forms when price cannot stay below. Stops change because volatility changes. Targets change because memory changes. Trailing changes only after the trade earns distance. That is the entire method. Price reaches. It reacts. It either holds or fails. Then you act. If price fails above the boundary, you short. If price holds below the boundary, you wait. If price holds lower memory, you long. If price touches a stop line already tested, you think again. If the safer stop reduces the ratio, you accept it. Because survival comes first. The chart will always offer a prettier number, but the market pays the structure that survives. Price moves up first, but it cannot keep distance. The session forms inside compressed memory. April 28th Asia session forms around the upper boundary of April 28th U.S. session box. It forms with almost half compression. The range is narrow. The reaction space is thin. Price is not starting from open space. It is starting inside pressure. That matters. When a session forms around another session upper boundary, the move can lift fast, but it can also fail fast. The box is already close to decision. You cannot chase every green candle. You need the lower boundary to hold. You need price to move away. You need the reaction to stay shallow. April 28th Asia session first builds near April 28th U.S. session upper boundary. Then price moves up. It breaks above April 27th Asia session upper boundary. That first break looks strong, but the break must stay. Price must create distance. Price must not fall back inside immediately. It continues. It breaks above April 27th U.S. session lower boundary. Then it breaks above April 27th U.S. session midpoint. Now the move has reached deeper memory. It is no longer just bouncing. It is trying to cross the prior U.S. structure. That is where most traders get pulled in late. The candles look strong. The move looks alive. The distance already traveled looks convincing. But the trade is not created at the top. The trade is created at the lower boundary. April 28th Asia session gives the long setup. Long entry line. April 28th Asia session lower boundary. Stop loss line. April 21st U.S. session midpoint. Take profit line. April 27th Asia session upper boundary. The first target sits at the upper boundary of April 27th Asia session box. Price already reacted around that structure. If the April 28th Asia lower boundary holds, the first real test above is April 27th Asia upper boundary. So the target goes there. Not beyond it. Not because we hope for more. The entry sits at April 28th Asia session lower boundary. Why there? Because the session forms compressed. A midpoint entry becomes weak. The box is too thin. Price can cross the midpoint several times. That does not give clean control. The lower boundary is different. If price holds the lower boundary, sellers fail to break the box. If price moves away from the lower boundary, buyers can build the next leg. That is where the long begins. Now the stop matters. There are closer options. You can use April 28th U.S. session lower boundary. You can use April 21st U.S. session upper boundary. Those stops look better. The ratio looks cleaner. The distance looks smaller. But the chart already gave warning. During April 28th U.S. session, hourly candles already touched the lower side. The market already tested that area. A stop placed too close to a tested level can get touched again. That touch may not break the larger idea. It may only be normal pressure. You are right about direction, but the position is gone. So the safer stop sits lower. April 21st U.S. session midpoint. That line gives more depth. It gives the long enough room. It avoids the already tested upper noise. It does not chase the prettiest number. It protects the structure. If price reaches below April 21st U.S. session midpoint, the lower memory is no longer holding. The long has failed. That is real invalidation. Not discomfort. Not noise. Real failure. Price moves upward from the entry area. It reaches April 27th Asia session upper boundary. The first target is paid, but price continues to push. Now you consider trailing. First trailing target, April 17th U.S. session upper boundary. Price has moved away from entry. The trade has earned distance, so the target can move higher, but the stop must move too. Target cannot move alone. If you move only the target, you are not managing. You are hoping. If you move the stop too tight, normal reaction removes you. Then the original trade pays more than the trailed trade. That happens often. So the stop must follow. But it must follow with room. Price moves again. It pushes into older upper memory. Second trailing target, April 27th U.S. session lower boundary. Risk-reward ratio, 2.55. That second trail only works after proof. Price must hold above the first target. Price must not return fast. Price must keep distance. If price cannot hold above April 27th Asia upper boundary, the trail should not expand. If price moves away and pullback stay controlled, the trail can continue, but the stop must still protect the earned move. If the stop moves with enough room, but still does not pass the entry line, trailing may not help. Then you do not trail. You either take the first target, or you keep the original plan. A trail must improve the trade. It must protect profit. It must reduce open risk. If it does not do that, it only creates confusion. Now look at the full path. April 28th Asia session forms compressed around April 28th U.S. upper boundary. Price breaks above April 27th Asia upper boundary. It breaks above April 27th U.S. lower boundary. It breaks above April 27th U.S. midpoint. It tries to test April 27th U.S. upper boundary. Then the move weakens. Price cannot keep distance. It falls back. It breaks below April 27th U.S. lower boundary. It returns to test April 27th Asia upper boundary. That return matters. The higher move did not stay. The breakout did not keep control. The market returns to the earlier target zone, so the long must be managed. You cannot treat a failed upper push as unlimited continuation. The trade was good, but it had to be controlled. Entry came from lower boundary holding. Stop came from deeper session memory. Target came from the next upper boundary. Trailing came only after movement was earned. That is the method. Not chasing, not guessing, not buying because price goes up. You wait for the lower boundary. You watch sellers fail. You enter when price moves away. You protect below real failure. You take profit at memory. Then you trail only when the trade earns it. Price reaches. It reacts. It holds or fails. Then you act. Price forms high, but it breaks down fast. The session forms between two upper memories. April 29th U.S. session forms exactly between April 17th U.S. session upper boundary and April 28th U.S. session upper boundary. It fits into that space. The location is important. Price is not starting from open air. It starts between old resistance and recent upper memory. The box forms near pressure. That means the first move can be violent. It can break down quickly. It can also snap back. So execution needs caution. April 29th U.S. session begins near that upper zone. Then price drops. It breaks below April 28th U.S. session upper boundary. That first break matters. But you do not chase immediately. You wait for the next test. Price continues lower. It breaks below April 28th U.S. session lower boundary. Now the whole April 28th U.S. box is lost. The move has pressure. Then price drops again. It breaks below April 21st U.S. session upper boundary. Then it breaks below April 21st U.S. session lower boundary. Now the drop has moved through another box. It is no longer only a local failure. It is moving through layered session memory. Price continues. It breaks below April 20th U.S. session upper boundary. Then it reaches April 20th U.S. session midpoint. It tests. It slows. That is the deeper objective. Now the short setup must be separated from the drop itself. You do not short because price is already falling. You short where the structure loses balance. April 29th setup gives the short. Short entry line. April 27th U.S. session lower boundary. Stop loss line. April 24th U.S. session midpoint. Take profit line. April 28th U.S. session lower boundary. First trailing target. April 21st U.S. session lower boundary. Second trailing target. April 20th U.S. session lower boundary. Risk-reward ratio 3.13. The entry sits at April 27th U.S. session lower boundary. Why there? Because price had already failed above. The April 28th move tried to push higher. It could not keep control. When price returns below April 27th U.S. lower boundary, the prior structure loses support. That gives the short. But this setup needs caution. The short entry appears right before the April 29th U.S. session basis candle. That matters. Right before a new session basis candle forms, the market can reset. The new box can change everything. Liquidity can shift. A level that looked like failure can become the new session origin. So this entry cannot be treated casually. Even when the structure looks right, timing can make the trade dangerous. Before the new U.S. session basis candle, price can move quickly in both directions. It can trap early shorts. It can sweep the boundary. Then it can continue lower, or it can reverse into the new session. That is why entering right before a basis candle is not preferred. If you take the trade, you reduce risk. If you want safer execution, you wait for the new session to form. Then you trade the new structure. Now the stop decision. There are two options. First option, April 27th U.S. session upper boundary. Second option, April 24th U.S. session upper boundary. But the chosen stop sits at April 24th U.S. session midpoint. Why? Because April 28th Asia session hourly candles already tried to test April 27th U.S. session upper boundary. That line already attracted pressure. If you place the stop too close to that area, price can touch it again. The short can still be valid. But you are out. The April 27th U.S. upper boundary looks logical. It also looks closer, but it may not give enough room. The safer stop must sit where the short really loses control. April 24th U.S. session midpoint gives that room. If price returns toward that midpoint, the downside break is no longer clean. The short has lost too much control. That is where you leave. Not because the ratio looks worse, because survival matters. Now the target. The first take-profit line sits at April 28th U.S. session lower boundary. Why there? Because price broke below April 28th U.S. upper boundary. Then it broke below April 28th U.S. lower boundary. When price returns through that box, the lower boundary becomes the first objective. The move does not need to collapse. It only needs to complete the failed April 28th box. That is the first target. Price drops. It reaches the target area. The short pays. Now the question changes. Take profit or trail. Trailing starts only after the trade earns distance. First trailing target, April 21st U.S. session lower boundary. The price has already moved through April 28th U.S. box. Now it reaches toward older memory. If it cannot reclaim the broken levels, the short can extend, but the stop must follow. Do not move only the target. Move the stop too. If the stop remains far above, you are giving back too much. If the stop is too tight, the reaction removes you. So the stop must follow structure, not emotion. Second trailing target, April 20th U.S. session lower boundary. Risk-reward ratio, 3.13. This stage needs more proof. Price must break through April 21st U.S. lower boundary. It must not return above it. It must continue to make lower reactions. If price holds below that memory, the second trail can continue. If price reclaims it, the short loses pressure. The trail ends the trade. Now look at the full breakdown. April 29th U.S. session forms between April 17th U.S. upper boundary and April 28th U.S. upper boundary. Price drops below April 28th U.S. upper boundary, then below April 28th U.S. lower boundary, then below April 21st U.S. upper boundary, then below April 21st U.S. lower boundary, then below April 20th U.S. upper boundary. Then it tests April 20th U.S. midpoint. That is a layered failure. But the trade still needs discipline. The entry was not risk-free. It appeared near the new U.S. session basis candle. That is a timing problem. A good structure can become a bad trade if the timing is weak. So the method must include timing. Do not enter automatically right before a session basis candle. Wait if the session is about to reset. Let the new box form. Then use its upper, midpoint, and lower lines. If you still take the setup early, size must be smaller. The stop must be wider enough. The target must be realistic. Now connect Part 1 and Part 2. Part 1 gave the long. April 28th, Asia lower boundary held. Price moved up into older memory. Trailing could extend only after proof. Part 2 gave the short. April 29th, U.S. area failed from upper memory. Price broke down through multiple boxes. But the entry required caution because it came right before the new session basis. Same market, opposite trades. Not because opinion changed, because behavior changed. Long starts when lower memory holds. Short starts when upper memory fails. Stop changes when a level was already tested. Target changes when the next box is reached. Trailing changes only when price earns distance. Now the final rule. Price reaches. It reacts. It stays or fails. If lower memory holds, long can build. If upper memory fails, short can form. If the entry comes before a new session basis, wait or reduce risk. If the stop sits on a tested line, move it to real failure. If trailing does not protect profit, do not trail. The chart offers movement, but movement is not enough. The trade needs location. The trade needs timing. The trade needs survival. Only then does the structure become executable. Price looks weak, but shorting here is dangerous. The session forms inside the same memory. April 29th Asia session forms almost exactly inside April 29th US session box. It does not form an open space. It overlaps. It compresses. Price is repeating the same fight. No clean new direction appears. The market sits below the 120 moving average, but it is already far away from it. That distance matters. Sellers already moved far. The downside already used space. A new short needs fresh failure. Without fresh failure, you are chasing distance. Every red candle looks tempting. But the move is late. Every push down feels obvious. But obvious is often dangerous. Price is far below the 120 moving average. The 120 line stays above. The distance is stretched. Shorting here asks price to keep falling after the easy distance is already gone. That is the trap. So we do not look for short first. We look for long pressure. Not because the market is bullish. Because sellers are extended. Because price is far from the 120 moving average. Because the short side needs more proof. April 29th Asia session gives that decision. Price first moves up. It breaks above April 28th US session lower boundary. It tries to reach April 28th US session upper boundary. The move is not perfect. It slows. It reacts. It cannot cleanly finish the upper test. That failure matters. But it does not give a short yet. The short is still late. The market needs fresh downside control. Price drops. It breaks below April 21st US session lower boundary. That drop looks dangerous. It looks like sellers are back. But look at location. Price is still far below the 120 moving average. Distance is still stretched. Shorting after that drop still means chasing weakness. You need to see if sellers can keep control. They cannot. Price rises again. It breaks back above April 28th US session lower boundary. Now the first warning turns into action. Sellers push down. They lost the lower memory. Price returned above the same boundary. That return matters. The long does not start from hope. It starts from failed downside. April 29th Asia session gives the long setup. Long entry line. April 29th Asia session lower boundary. Stop loss line. April 20th US session midpoint. Take profit line. April 28th U.S. session upper boundary. The entry sits at April 29th Asia session lower boundary. Why there? Because the session overlaps almost perfectly with April 29th U.S. session box. The lower boundary becomes the place where sellers must prove control. Price reaches lower memory. It does not collapse. It turns. It moves away. Sellers fail to break the box. Buyers begin to build the return. That is where the long starts. You do not enter at the top. You do not enter after the breakout. You do not buy every green candle. You wait for the lower boundary. Price must hold there. Price must move away. Price must make sellers fail first. Now the target. Take profit line. April 28th U.S. session upper boundary. That target is not random. Price already broke above April 28th U.S. session lower boundary. It already tried to reach April 28th U.S. session upper boundary. When the long begins from April 29th Asia session lower boundary, the next real test is above. That test is April 28th U.S. session upper boundary. The target sits there, not higher, not because we want more, because that is the next memory. Price reaches April 28th U.S. session upper boundary. It touches. It does not leave. It pushes again. The candle becomes smaller. Reaction comes back faster. It tries one more time. Distance does not grow. The target has already done its job. That is where many traders make the mistake. They see the long working. They ask for more. But price is already at the next memory. It reaches. It stalls. It fails to build distance. The trade has paid. Do not turn a completed structure into a hope trade. Now the stop. There are closer stop options. Some may place the stop at April 20th U.S. session upper boundary. That gives a better looking risk-reward. It looks efficient. It looks clean. But the chart is not clean. April 29th Asia hourly movement already shows pressure. The lower side is not quiet. Price can dip into nearby memory. It can touch a close stop. Then it can move in the planned direction. You are right, but you are gone. So the safer stop sits deeper. April 20th U.S. session midpoint. At minimum, the stop needs to sit below the midpoint area. April 20th U.S. session box still controls the lower memory under the trade. If price reaches only April 20th U.S. session upper boundary, the long may still be alive. That can be noise. That can be a normal lower test. But if price reaches April 20th U.S. session midpoint, the lower structure has weakened much more. The long idea is no longer clean. That is real damage. So the stop goes there, not because it gives the best ratio, because it gives the trade room to survive. The market does not pay the prettiest stop. It pays the stop that survives normal movement. Now watch the trade again. Price moves up from the entry area. It returns above April 28th U.S. session lower boundary. It keeps pushing. It reaches toward April 28th U.S. session upper boundary. It touches. It stalls. It reacts. The long worked, but the upper memory blocks continuation. That does not make the trade bad. It makes the target correct. The long worked because sellers could not hold below. It did not work because the market became safe. It worked because downside failed first. Now the full structure becomes clear. April 29th Asia session forms almost exactly inside April 29th U.S. session box. Price is far below the 120 moving average. Late shorts become dangerous. Price moves above April 28th U.S. lower boundary. it fails to finish cleanly. It drops below April 21st U.S. lower boundary. Sellers still cannot keep control. Price rises again. It breaks back above April 28th U.S. lower boundary. It tests April 28th U.S. upper boundary. The long comes from that failure sequence, not from guessing, not from calling a reversal. The long starts when sellers fail at lower memory. The stop sits where that failure no longer matters. The target sits where the next memory waits. That is the trade. If price cannot stay below lower memory, longs can form. If price cannot reach the target, the trade weakens. If price reaches April 20th U.S. midpoint, the long is damaged. If price reaches April 28th U.S. upper boundary, the planned move has paid. Everything is conditional. No chase. No prediction. Only tested structure. Price compresses again, but the trade does not appear. The session forms inside prior pressure. April 30th U.S. session forms near the lower boundary of April 29th U.S. session box. It forms with about 60% compression. It overlaps. It stays close to prior memory. That deserves attention. When a new session compresses near the prior day's session memory, the market prepares a decision. But preparation is not entry. Compression alone is not a trade. Overlap alone is not a trade. You still need price to break. You still need price to hold. You still need price to fail. You still need price to return. April 30th U.S. session gives the environment, but it does not give clean execution. Price stays inside April 30th U.S. session box. It continues inside the box. It does not create clean distance. It does not break far enough. It does not give a clean failure. That is the problem. Many traders force trades here. They see compression. They expect expansion. They enter early. Then price rotates inside the box. The stop gets touched. The entry was not wrong by direction. It was wrong by timing. That is why no trade matters. April 30th U.S. session sits below the 120 moving average. April 29th Asia session had also compressed below the 120 moving average. Now April 30th U.S. session compresses again. Probability may lean long. Shorts can still be late. The downside can still be stretched. A return toward the average can form. But that is not enough. Better direction is not entry. A better probability still needs a line. It still needs failure. It still needs a place to stop. It still needs a place to take profit. April 30th U.S. session does not give that cleanly. Price stays inside its box. The lower boundary does not give a strong hold. The upper boundary does not give a clean breakout. The midpoint does not give control. The candles move, but they do not decide. Now the pain begins. Price flicks above the midpoint. Your finger wants the long. Then it falls back inside. Price taps the lower side. Your finger wants the short. Then the wick pulls back again. Nothing breaks. Nothing holds. Every small move asks for action, but every action is early. The box is compressed by almost 60%. The midpoint is too close. Wicks keep touching it. Price crosses it once, then returns. It crosses again, then fails again. The midpoint does not decide. It only traps the impatient hand. You see a green candle. It feels like the long is starting. Price cannot leave the box. You see a red candle. It feels like the short is starting. Price cannot stay below. The candle body is small. The wick is loud. The reaction comes fast. The distance stays short. The box keeps pulling price back. This is where waiting hurts. Not because waiting is boring, because every candle looks usable. Every small push looks like the start. Every wick looks like a signal. Then it returns. Again, again, again. That is how the box drains discipline. It does not move far enough to give a clean trade. It moves just enough to tempt you. It does not break cleanly. It only touches. It does not hold. It only flickers. That is why you do nothing. You want to apply the long bias. But the session does not confirm it. You want to catch the move before it runs. But early entry creates bad risk. So the better trade is no trade. That protects the account. That protects the method. That protects the next opportunity. Now look at the reason. April 30th U.S. session forms near April 29th U.S. session lower boundary. It compresses by about 60%. The box is not wide enough to give comfortable internal execution. Midpoints become weak. Price can cross the midpoint repeatedly. A midpoint entry can get trapped. A midpoint stop can get touched. A midpoint target can be too small. So you avoid forcing the middle. You wait for the edge. Price must hold the lower boundary and move away. Or price must break the upper boundary and stay above. Or price must fail above and return inside. One of those must happen. Without that, there is no trade. Now connect it to the 120 moving average. Price is below the 120 moving average. The distance from the average can make shorts less attractive. So you do not rush to short. But price also does not give a clean long. That creates tension. Long looks better than short, but no entry is better than a weak long. That is the key. The market can favor one side without giving a trade. You do not need to participate. You need clean execution. If April 30th U.S. session had held the lower boundary and moved away, the long could form. If it had reclaimed a strong upper boundary and stayed above, the long could continue. If it had failed above the upper boundary and returned sharply, a short could appear. But inside the box, nothing is confirmed. The session gives pressure, not execution. Now think about stop placement. If you force a long inside April 30th U.S. session box, where does the stop go? Too close. You get touched. Too far. The risk becomes ugly. Inside a compressed box, both choices can be bad. That alone can cancel the trade. A trade needs a place to be wrong. If you cannot define that place cleanly, you do not enter. Now think about target placement. If you enter inside the box, where is the first target? The upper boundary is too close. The next memory may be far. The risk-reward becomes unstable. Price can stall before target. It can return before proof. So again, no trade protects you. No trade is not passive. No trade is execution discipline. You are not avoiding the market. You are waiting for the market to give a line worth trading. April 30th U.S. session does not do that yet. It compresses. It overlaps. It rotates. It keeps price inside. So you wait. Now the likely bias remains. Since price is below the 120 moving average and already compressed across prior sessions, long may still have better potential than short. But the long must appear. It must hold lower memory. It must break and stay. It must create distance. Until then, you do nothing. That is still strategy. No trade is not empty. No trade is a position. It means the setup did not pass the filter. It means risk could not be placed cleanly. It means the target did not justify the entry. It means the session has not decided. Now the full day becomes clear. The earlier structure gave the long. April 29th Asia session overlapped. April 29th US session box. Price was far below the 120 moving average. Shorting late was dangerous. The long came from lower boundary holding. The stop sat deeper at April 20th US midpoint. The target sat at April 28th US upper boundary. Then, the next structure changed the answer. April 30th US session compresses near April 29th US lower boundary. It stays inside its own box. Long may be better than short. But the entry is not clean. So no trade is better. Same method. Different answer. One session gives execution. The next session gives waiting. That is real trading. You do not need a position every time. You need the right position. Price reaches. It reacts. It holds or fails. If nothing decides, you wait. Because survival comes first. The next trade begins only when the session gives the line. Price pushes higher, but it must survive the box. The session forms inside compressed memory. April 30th Asia session forms at the midpoint of April 30th US session box. It compresses there. It overlaps there. It does not form in open space. The range is already tight. The distance is already controlled. Price sits inside the prior US memory. That matters. When Asia forms at the midpoint of the April 30th US session box, the market is not free yet. It can move up. It can fail. It can return inside. So we do not chase the first candle. We wait for the box to decide. Price moves up. It reaches April 30th US session upper boundary. It breaks above. That first break matters. But a break alone is not enough. Price must stay above it. Price must move away. Price must protect distance. It pushes again. It reaches April 29th US session upper boundary. It breaks above that level too. Now the move looks strong. But strength must keep moving. If it stalls too close to the line, the breakout weakens. If it returns too fast, the breakout becomes a trap. Price continues higher. It breaks above April 27th US session upper boundary. Now the move has crossed multiple session memories. It is no longer a small bounce. It is trying to expand through old pressure. Then price reaches toward April 24th US session midpoint. It tries to test that area. The move is extended now. The early space is gone. Now every pullback matters. Every stall matters. Every reaction matters. April 30th Asia session gives the long setup. Long entry line. April 30th Asia session upper boundary. Stop loss line. April 21st US session upper boundary. Take profit line. April 29th US session upper boundary. The entry sits at April 30th Asia session upper boundary. Why there? Because price forms around April 30th US session midpoint. Then it pushes toward the upper boundary. When price breaks above April 30th Asia session upper boundary, the session begins to lean upward. The upper boundary becomes the decision line. If price holds above it, buyers can build the move. If price falls back below it, the move loses control. So the long does not begin because price is green. It begins because price leaves the compressed box and holds above the upper boundary. You do not enter inside the middle. The midpoint is too close. The box is compressed. Price can cross the midpoint without choosing direction. The upper boundary is different. It forces the market to decide. Price breaks above it. It tries to stay. That creates the long. Now the first target. Take profit line. April 29th U.S. session upper boundary. That target is not random. April 29th U.S. session upper boundary is the next session memory above. Price already fought around that area. If April 30th Asia upper boundary holds, the first clean upside target is April 29th U.S. upper boundary. So the target goes there. Not higher at first. Not because we want more, because the next memory waits there. Price reaches April 29th U.S. session upper boundary. It tests. It reacts. The first job is complete. If price stalls there, the trade has paid. If price holds above it, the next trail can begin. Now the stop. There is a closer option. Some may place the stop at April 30th U.S. session lower boundary. That gives a better-looking risk-reward. It looks efficient. It feels clean. But the chart is not that clean. April 30th U.S. session already showed hourly movement around the lower side. The box has noise. The range is compressed. A stop at the April 30th U.S. lower boundary can get touched by normal reaction. That touch may not kill the larger long structure. It may only test lower memory. You can be right on direction, but the position is gone. So the safer stop sits deeper. April 21st U.S. session upper boundary. At minimum, the stop needs to sit below that area. Why? Because April 21st U.S. upper boundary holds older memory under this move. If price only returns to April 30th U.S. lower boundary, the long may still be alive. If price reaches below April 21st U.S. upper boundary, the upward attempt is much weaker. The breakout from April 30th Asia has lost real control. That becomes damage. That becomes invalidation. So the stop goes there. Not because the ratio is prettier, because the trade needs room to survive. The market does not reward the tightest stop. It rewards the stop that sits where the idea is wrong. Now the trade starts to move. Price breaks above April 30th U.S. upper boundary. It holds. Price breaks above April 29th U.S. upper boundary. It reaches the first target. Pressure changes. The long has paid. Now you decide. Take the trade or trail. Trailing begins only after proof. Price must move away first. The trade must earn distance. First trailing target. April 27th U.S. session upper boundary. At first that sounds odd, because price has already crossed it. But the trail is not only about target. It is about management. Price must hold the broken memory. If price stays above April 27th U.S. upper boundary, the long can press higher. If price falls back below it, the upward expansion weakens. So the stop must follow. Target cannot move alone. If target moves higher and stop stays behind, that is not management. That is hope. If the stop moves too tight, normal pullback touches it. Then the original plan pays more than the trailed plan. So the stop follows with room. Not too close. Not too far. Second trailing target. April 24th U.S. session upper boundary. Risk-reward ratio 4.16. That second trail needs proof. Price must keep distance. Price must hold above April 29th U.S. upper boundary. Price must not return fast into April 30th Asia structure. If price keeps moving, The older April 24th U.S. upper boundary becomes the next memory. Then the trade can press. But if price hesitates and starts returning, you do not force the trail. No proof, no second trail, no movement away, no larger target. Now the rule for trailing becomes clear. When the take-profit line changes, the stop must also change. A bigger target without a moving stop only adds hope. It does not reduce risk. If the new stop is too tight, the market touches it. Then the trail damages the trade. If the new stop gives enough room, but still does not move beyond entry, the trail may not protect anything. Then you do not trail. You take the original target, or you wait for real distance. A trail must protect profit. A trail must improve the position. A trail must come after the market pays. Now look at the full structure again. April 30th Asia session forms at April 30th U.S. session midpoint. It compresses. It overlaps. Price breaks above April 30th U.S. upper boundary. It breaks above April 29th U.S. upper boundary. It breaks above April 27th U.S. upper boundary. It reaches toward April 24th U.S. midpoint. The long comes from the first controlled escape, not from chasing the top, not from buying late strength, not from assuming continuation. The long begins when April 30th Asia upper boundary holds. The stop sits at April 21st U.S. upper boundary because the closer stop is too exposed. The first target sits at April 29th U.S. upper boundary. The trail can extend only after proof. That is the method. Price reaches. It reacts. It holds or fails. If it holds above the box, the long survives. If it returns below old memory, the long is damaged. If it reaches the next boundary, the trade has paid. Then the next decision begins. Price expands high, but the trade still does not appear. The session forms at a larger boundary. May 1st U.S. session forms exactly around the lower boundary of April 24th U.S. session box. It expands close to 200%. It overlaps there. The structure is not small. The range is wide. The session is sitting on older memory. That deserves attention. When a new U.S. session expands near a prior U.S. session lower boundary, the market is not quiet. It can create large movement. It can trap both sides. It can form a strong reaction without giving clean execution. May 1st U.S. session gives pressure. But pressure is not entry. The session first continues inside April 30th U.S. session box. It stays within that structure. It does not give a clean break early. It does not give a clean hold. It does not give a clean failure. Price moves. But the movement stays inside memory. That makes the trade difficult. Then price later drops. It breaks below May 1st U.S. session lower boundary. It ends the U.S. session below that line. That looks bearish. The top test failed quickly. The session could not hold its upper side. Price ended lower. So the probability may lean short. But probability is not execution. Short bias is not entry. You still need a clean line. You still need a place to be wrong. You still need a target that justifies the risk. May 1st does not give that cleanly. Now look at the upper test. May 1st U.S. session expands above. It tests the upper area. It fails quickly. That failure matters. If the upper test fails, and price cannot stay high, short pressure can build. But the session is large. The box is extended. The stop distance can become wide. The move can already be late. You cannot short just because The top failed once. You need the return line. You need the failed reclaim. You need the next boundary. Without that, you are entering inside noise. Now consider the context. This is the final session of the week. That matters. The final session can move violently. It can clean up liquidity. It can reverse fast. It can trap late entries. A setup that looks clean on Tuesday can become dangerous on Friday. The week is ending. The market may not give continuation. It may only give a last reaction. So even when short looks better than long, you still need restraint. May 1st U.S. session formed above the 120 moving average. It expanded near older memory. The top test failed fast. The lower boundary later broke. That favors short pressure. But the hourly flow does not give a clean execution point. Price stays inside. April 30th U.S. session box first. It rotates. It compresses. It does not create clean distance. Then it breaks lower late. By the time the break appears, the move can already be stretched. The stop becomes awkward. The target becomes unclear. The timing is weak. That is where you do nothing. Not because nothing happened. A lot happened. But the trade did not pass the filter. The market gave movement. It did not give clean execution. That difference protects the account. Now think about the long side. Could a long form? Only if price holds a lower boundary and moves away. But May 1st fails at the upper test. Then it breaks below its lower boundary. That long side is not clean. Buying that structure means fighting the failed upper test. You need strong holding below. You need a clear reclaim. You need distance. Without that, the long is weak. Now think about the short side. Could a short form? Yes. Probability may lean short. But where is the clean entry? If you short inside April 30th U.S. session box, price can rotate against you. If you short after May 1st lower boundary breaks, the move may already be late. If the stop goes above May 1st upper area, risk becomes wide. If the stop goes too close, a normal wick can remove you. So the short also fails the execution filter. That is why no trade is better. The chart gives temptation. The top fails. Your finger wants the short. Then price rotates inside. The lower line breaks. Your finger wants the short again. Then the stop becomes too wide. The final session pushes. Your mind wants action. But the line is not clean. Every trade needs three things: entry, stop, target. May 1st gives bias. It does not give all three cleanly. So you wait. Now compare it with the earlier long. The earlier structure gave a clear entry. April 30th Asia upper boundary. It gave a clear stop. April 21st U.S. upper boundary. It gave a clear target. April 29th U.S. upper boundary. Then trailing could follow. May 1st does not match that. It gives a failed top. It gives a large box. It gives a late lower break. It gives pressure. But it does not give clean trade quality. So the answer changes. No trade. That is not weakness. That is discipline. Many traders think no trade misses opportunity. But a forced trade damages the next opportunity. A bad entry creates stress. A bad stop creates panic. A bad target creates hesitation. Then the next clean setup appears, and the account is already hurt. No trade saves the next trade. Now read May 1st again. May 1st U.S. session forms at April 24th U.S. lower boundary. It expands close to 200%. It overlaps prior memory. It moves inside April 30th U.S. session box. The upper test fails quickly. The lower boundary breaks later. The week is ending. Short may look better, but the trade is not clean. That is the decision. No forced entry. No late short. No emotional long. Wait for the next session. Let the next box form. Let price show whether the May 1st lower break can stay. If it stays below, the next short can form. If it reclaims the lower boundary, the failed breakdown can reverse. If it compresses again, you wait again. Everything must come from the next test. Price reaches. It reacts. It holds or fails. Without that, there is no trade. Now the full day becomes clear. The earlier session gave the long. April 30th Asia compressed at April 30th U.S. midpoint. It broke above the box. It reached stacked memory. The long had structure. Then the next session gave caution. May 1st U.S. expanded at April 24th U.S. lower boundary. It failed the upper test. It ended below its own lower boundary. Short pressure appeared, but execution did not. Same method. Different answer. One structure gives action. The next structure gives waiting. That is real trading. You do not need a position just because price moved. You need the right position. You need a line that matters. You need a stop that survives. You need a target that pays. May 1st does not give enough. So you protect the account. You wait for the next session memory. The next trade begins only when the structure gives the line. The 1-hour chart showed the fight. Now the larger charts show the pressure. Daily chart, weekly chart, monthly chart. The week becomes clearer there. The 1-hour chart gave the trades, but the higher time frame gave the limits. Price moved up. It broke boundaries. It reached targets. Then it stalled. It returned. It rotated. That was not random. The daily chart shows why space disappeared. The weekly chart shows why the structure stayed trapped. The monthly chart shows why recovery still needs proof. So now we stop reacting candle by candle. We step back. Not to predict, to prepare. The daily chart shows where this week traveled. Price moved from lower memory. It pushed into the February daily box. It reached toward the 0.5 area. That is where late entries lose space. A 1-hour long can work early. But late buying near daily resistance becomes dangerous. The daily chart gives the warning. The weekly chart adds the trap. Price is still inside the February structure. It has moved between falling trend lines. It has broken upward. But it still sits between old weekly boxes. The breakout has to stay. If it returns inside, the move fails. The monthly chart gives the largest pressure. April formed between the 0.33 and 0.55 area. It checked the March upper wick. It overlapped the February drop. It moved toward the 2026 first monthly lower boundary. That looks like recovery. But recovery still has to hold. Until price stays above monthly memory, it is still testing. That matters for next week. The 1-hour chart gives entries, but the higher time frame decides how much room remains. If daily resistance is close, targets must be realistic. If weekly compression remains, breakouts can fail faster. If monthly memory sits above, late longs can lose space. So next week the plan stays strict. Do not chase strength into the 0.5 area. Do not short weakness without fresh failure. Do not enter inside compression without a clean edge. Wait for price to reach the boundary. Wait for reaction. Wait for holding or failure. Then execute. The higher time frame does not replace the session. It protects the session trade. Daily gives space. Weekly gives pressure. Monthly gives context. The 1-hour chart gives the entry. Now the daily chart comes first. Price moves up, but there is no space left for late entry. The daily structure forms inside older memory. April 1st daily candle forms around the midpoint of March 1st daily candle box. It compresses there, it overlaps there. It does not begin from open space. Price starts from March memory. Then price moves up. It breaks above March 1st daily candle box upper boundary. That break matters, but it still has to travel into the next box. Price pushes again. It breaks above February 1st daily candle box lower boundary. Now the move looks strong, but the structure is narrowing. The week is not moving through empty air. It is rotating inside February 1st daily candle box. The important range is clear. The lower side of February 1st daily candle box. The upper side of February 1st daily candle box. This week's daily flow stayed between them. That is the main daily rotation. Price pushes from lower memory. It reaches toward upper memory. But the space between those lines is limited. That is why the 1-hour chart kept showing pressure. A move could run, then stall. A breakout could work, then lose distance. A late entry could look good. Then the target would be too close. The daily chart explains that. March 1st daily candle box lower boundary sits near the 0.33 area. February 1st daily candle box upper boundary sits near the 0.5 area. Price has moved from the lower memory toward the 0.5 pressure zone. Now three things come close. The 120 simple moving average. The 0.5 area. February 1st daily candle box upper boundary. That cluster changes execution. You do not buy blindly there. You do not assume continuation there. You need proof. Price must reach the cluster. It must hold. It must move away. If it cannot stay, it returns. That is why late longs become dangerous. The 1-hour chart can show green candles. The daily chart can still say, there is no space left. A trader who enters early from session memory has room. A trader who enters late near daily resistance has pressure immediately. The stop becomes wide. The target becomes short. The trade becomes uncomfortable. That is why this week required boundary entries, not chase entries. When price was near lower session memory, longs could form. When price was already near daily resistance, the trade needed more caution. Now look at the 120 simple moving average. Price approaches it. The line does not give a trade by itself, but it adds pressure. When the 120 simple moving average overlaps with the 0.5 area and February 1st daily upper boundary, the market has to prove acceptance. If price only touches and stalls, the move can return. If price holds above and builds distance, the next long can form. That is the daily decision. The daily chart also explains no trade days. When price sits between boundaries, the 1-hour chart can flicker. Midpoints can get crossed. Wicks can touch. Candles can look useful. But the larger daily space does not open. Then forcing a trade becomes dangerous. The daily chart tells you when the 1-hour move has room. It also tells you when the 1-hour move is late. That is the lesson. This week was a rotation inside the February 1st daily box. Price moved up from the lower side. It tested the upper side. It approached 0.5. It approached the 120 simple moving average. It approached the February 1st daily upper boundary. Now next week begins near that pressure. So the plan is not emotional. If price holds above the daily cluster, long continuation can form. If price reaches the cluster and fails, short setups can appear. If price stays inside the February daily box, range trading stays more realistic. The 1-hour chart must confirm. Asia session forms. US session forms. Price reaches a boundary. It reacts. It holds or fails. Then you act. The daily chart gives the map. The session chart gives the trigger. Now the question becomes simple. Does this make the week clearer? The answer should be yes. The 1-hour chart kept moving up, then stalling. Now the daily chart shows why. Price was traveling through daily rotation towards stacked resistance. That is why entry quality mattered. That is why late trades had no space. That is why next week needs patience. Price breaks out, but the weekly structure still traps it. The weekly candle sits inside old memory. This week's weekly candle is positioned between April 1st weekly candle box upper boundary and February 1st weekly candle box upper boundary. It is not in open space. It sits between two prior structures. That matters. A move can look strong there, but it still has to escape the larger box. Price has not escaped cleanly yet. The structure from February still matters. We have been tracking it since February. The market is still inside that larger fight. April 1st weekly candle forms inside. March 1st weekly candle box. March 1st weekly candle forms inside. February 1st weekly candle box. Compression keeps repeating. February holds March. March holds April. Now this week trades between April 1st weekly upper boundary and February 1st weekly upper boundary. The boxes keep pressing price into narrower decisions. That is why 1-hour moves can be sharp, then fail. That is why a breakout can run, then return. That is why a good intraday trade still needs trailing. The weekly chart shows a larger trap. From February, price moved between the first falling trend line and the second falling trend line. It moved sideways there. Then it broke upward. That upward break matters. But a break alone does not finish the job. Price must stay outside. It must build distance. It must make pullbacks shallow. If it returns back inside the trendline area, the breakout loses power. So the weekly chart gives two messages. One message is positive. Price pushed out from the falling trendline zone. The other message is caution. Price still sits below larger weekly memory. That is why we cannot chase. The weekly chart also shows that February, March, and April weekly boxes formed below January 1st weekly box. That keeps a ceiling above the move. Price can rally, but it still trades under larger memory. So next week cannot be treated as full freedom. It must be traded as a test. Can price stay above the compressed structure? Can price hold outside the falling trendline area? Can price move toward higher weekly memory without returning inside? If yes, longs can continue. If no, failed breakout shorts can form. Now connect this to the daily chart. The daily chart shows price near the 0.5 area and the 120 simple moving average. The weekly chart shows price between old boxes. Both say the same thing. The move is strong, but the space is not clean. That is why the 1-hour chart requires execution discipline. A 1-hour breakout can be valid, but the target must be realistic. A 1-hour long can work, but late entries near weekly pressure become dangerous. A 1-hour short can work after failed holding, but shorting without failure becomes chase. The weekly chart controls the environment. If price holds above weekly compression, pullbacks can become long setups. If price fails and returns inside, short setups can appear. If price keeps rotating inside the weekly boxes, targets must be closer. Breakout chasing becomes weaker. Boundary trading becomes stronger. That is the strategy. Do not ask whether price is bullish or bearish. Ask where it can stay. If price stays above the broken trendline area, the breakout survives. If price returns below it, the breakout fails. If price reaches weekly upper memory and stalls, you reduce long expectations. If price pulls back to weekly support and holds, you look for 1 hour long entries. This is why higher time frame matters. The 1 hour chart gives action. The weekly chart gives survival conditions. It tells you when to press. It tells you when to reduce. It tells you when no trade is better. Now the weekly structure is clear. The week broke upward from the falling trendline zone, but it still sits between April 1st weekly upper boundary and February 1st weekly upper boundary. Compression remains. The breakout needs holding. Next week starts inside that question. Can price stay outside the old pressure? Or does it return again? That answer will shape the next 1 hour trades. Price looks like recovery, but the monthly chart still demands proof. April monthly candle forms between the 0.33 area and the 0.55 area. It does not close above full freedom. It forms inside the larger recovery zone. April checks the upper wick of March monthly candle. It overlaps the falling part of February monthly candle. That matters. Price is moving back into the prior drop. It looks strong. It looks like reversal, but the candle still has to hold. The monthly chart is slower, but it controls the largest pressure. April is trying to recover through the February decline. It is also testing the lower boundary of the 2026 first monthly candle box. That area sits near the 0.5 zone. That is not random. The 2026 first monthly candle box formed, overlapping the lower boundary of the 2025 first monthly candle box. So the current move is approaching stacked monthly memory, 2025 first monthly lower boundary, 2026 first monthly lower boundary, 0.5 area. They are close. Price reaches toward them. Now the market must prove holding. If price reaches that monthly zone and cannot stay above, the recovery weakens. If price holds above that zone and builds distance, the larger recovery can continue. But until that happens, the monthly chart still says test, not confirmation. That matters for next week. The 1 hour chart can move fast. The daily chart can rotate. The weekly chart can break a trend line. But the monthly chart still controls the largest decision. If price is pressing into monthly memory, late longs need caution. If price rejects that memory, short setups can form on smaller time frames. If price pulls back and holds daily or weekly support, long setups can form again. The monthly chart does not tell you to buy or sell immediately. It tells you where price must prove itself. Now connect April to the week. April formed between 0.33 and 0.55. The week's 1 hour chart moved inside that larger monthly recovery zone. That explains why price could rally. It also explains why price stalled. There was room from lower memory, but not unlimited room. As price approaches the 0.5 to 0.55 area, the next resistance appears. That is why the daily chart showed no space for late entry. That is why the weekly chart showed breakout but still trapped. That is why the monthly chart says Recovery is not complete. The larger message is clear. The market may be recovering, but recovery needs staying power. It must stay above monthly memory. It must not return immediately. It must hold the 2026 first monthly lower boundary. If it cannot, the move becomes another test. A test can fail. A failed test can return. That return can create short setups on the 1-hour chart. But if price holds, the next week can build continuation. Then the 1-hour chart becomes the execution tool. You do not trade monthly candles directly. You use monthly structure to prepare the next session plan. If price opens next week near monthly memory, do not chase the first move. Watch the daily boundary. Watch the weekly compression. Watch the next Asia and US boxes. If price forms inside the same memory, wait for failure or holding. If price breaks above and stays, longs can continue. If price breaks above and returns, shorts can form. If price drops into support and holds, the next long can build from lower memory. That is how the timeframes connect. Monthly gives the zone. Weekly gives pressure. Daily gives active rotation. 1 hour gives the trade. Now the week is complete. The 1-hour chart showed execution. The daily chart showed limited space. The weekly chart showed breakout under pressure. The monthly chart showed recovery still testing. Next week, the plan is not prediction. It is preparation. Mark the monthly memory. Mark the daily 0.5 area. Mark the weekly compressed boxes. Then wait for the next session. Price reaches. It reacts. It holds or fails. That answer creates the trade.